Hey guys, Brian here. Welcome back to the channel. And today we're going to be talking about the wheel strategy, because I said every week I'm going to kind of tell you what I'm doing with my portfolio. So let's just jump right into my desktop and I can show you the option chain on Tesla right over here. So here we are on Tesla. I'm good. My screen isn't blocking any of the delta or anything. So let me go and look at my app on my phone, because I don't want to open it by accident on here, and then you guys see everything that I got and all my personal information and all that. But so like I told you guys before, I have 300 shares of Tesla, so I'm doing covered calls with this stock. And the reason why I do it with Tesla is because it gives me the most premiums for what I'm looking for at the moment. Okay, so this is what I did for this one. Okay, so here we are. So the price is 166, down 1.63 points, pretty much down 1% on the day. So what I did, because the week ending is on Friday, May 19th. So of course we're on May 19th. And my cost basis of this was around $187. So we are down at least $2,000 on this right now. But that doesn't really matter for the wheel strategy, because you're making all these premiums that technically that $2,000 we're down isn't realized until we actually sell, or the shares are taken away from us. Sorry, I'm just moving my camera a little bit. So I've been collecting premiums every week on this, so I'll be passing that $2,000 very soon. So I won't even, I'll break even, or even better, I'll keep going further and further, and I never really get this called away from me. So here we are. I actually chose, so again guys, because we have 300 shares of the stock, we are on the call side. That means we want the stock to go up. We are using the shares as collateral here, and so we want the shares to go up. And obviously, since my cost base is 187, that's not even on the option chain right here, but you have to choose it based off delta. That's usually what I go off. Delta means like the percentage that it's most likely going to be assigned to you. Like you're gonna have your shares taken away from you, or you're gonna have your money taken away from you to buy shares. So usually I was saying I would stick at the 30% mark, but because of how volatile the market is, I've been slowly going to the 20 to 15%. So how do you calculate delta? So right here, if you just look at 155 right here, so this 0.89. So you just move this decimal point 2 spots over to the right, and that would make it a 89% chance that your shares are going to get called away from you. Whereas you look on the bottom side, 0.13, you move the decimal points 2 spots to the right, 13% chance that they'll be called away from you. So of course, we don't want our shares to be called away from us, because we are so far away from our cost basis. So I actually, lately, I've been looking at like the 20s to see what I could actually get for 20 strike prices. So I like to see all the way up to where I was at, like say 187. I would only be getting around $13 per contract. And it's better than dividends for sure, but it's not exactly what I want. So I actually went, and that's like a 2% chance out of going. So I actually went with the 13% chance of it. And I didn't get $66. I actually got $89. I actually got $85 per contract. $85 per contract. So that's pretty good. So I can't even do math on the top of my head right now because I'm so tired. So 85 times, let's put my calculator on here. 85 times 3. $255 for writing these contracts, just for doing it right here. So I picked 177.5. It's a 13% chance I'll be called away. Obviously, the stock price is already down 1%. So, and I got it like $20 better than this. So of course, the closer we get to Friday, the lower the premiums are going to be. So that's why I always do mine around like 10 a.m. on Monday mornings. 9:30, not so much, because I don't really know where the market is going. So I kind of like watch the market for a little bit, and I watch the stocks that I'm doing this with, just to kind of get a feel of where I might think it might go. And plus, I also look at any news that might have happened over the weekend over that 30 minutes to find out if there's any catalyst that might make this explode or bottom out. So those are like a few tips that I would do. So I did this with 3 contracts. So I got around $255. And because I also have some extra money lying around, so I also do this with Amazon. And let me look at what I actually chose for my Amazon contract. Let's see. I chose, I think, like 102. Did I put 105? So I chose 105 for my strike price. See, it's not even on here. So I'll have to put in 20, apply. So 105. So 105. And look here. I almost looked at this side because I was looking at calls, but we're not, because I have the extra money. I have the like $10,000 sitting in my account. I chose 105. So you'll have to look at the put side over here. And if you look at the delta, you have a 5% chance this is going to be taken away. So the bid was $9, but I actually believe I got around 20 something for this. Let me take a look again. I actually got $25 for this. I got $25 for this contract right here. So obviously, like I said, the closer you get to Friday, since some trading days already closed, it's not $25 anymore, it's $9. So I got $25 for writing that contract. And I did this with 2 contracts, so I got $50 on that. So that puts me at $300 for the week. Easy money. And like I said, like I always like to show you guys. So if I put $300 and say I started the year right now, even though it's a lot lower than what I originally showed you guys with how the premiums were like pumping out like a few $100s each. So I was getting like almost like $1,200 a week. Even with a low amount like this, like $300 a week, say I do it every week until this time next year, that's $15,000, $15,600 over a year. Guys, that is a lot of money, and it's a lot of money that a lot of people are leaving on the table because they just don't understand this. And I try to go over it with a lot of people, is that you're just either putting up your shares for collateral or your dollars for collateral. And the only difference is just figuring out how risky you want to be. So I always look at delta. Like I said, I've been putting mine to 20% or lower now because of how volatile the markets are and we don't really know where things are going. And I'm still generating $300 a week. That is a lot of money. And if you have the shares and if your stock plummeted like how mine did with Tesla, you just have to pick those strike prices that are far enough away where your stock, where your stocks won't get taken away from you. And then you get to like live to fight another week, and in hopes that the stock will eventually go up back towards your cost basis, where you'll be able to not only make premiums, but also be able to sell if you wanted to for profit. And that's where you could double dip. And then there's another thing that people are saying, like, oh, I don't really have $10,000 or whatever. So I was shown by a friend that like you could do this with Riot, right? Riot blockchain. So this is a very volatile stock where it's going to follow what Bitcoin is doing. So it's only $11. So you just need around $1,000 or $1,100 to start doing this, or $900 if you want to pick this strike price. So if you had $1,000 and you wanted to do this, right, you have to figure out what you're comfortable with buying this stock at, right? So I personally, if I was to do this and I had $1,000, maybe I would put it at the $10 mark. So it's $1,000 and I would get $12 of premium right here. That's a 20% chance that it would actually do it. So you automatically gain the $12. And guys, I know it's just $12, but think about all the dividend investors that are super excited just to get $12 every month. Whereas you could be getting $12 almost every week. You're 4xing what they're making like every month. So that's one way to do it. So Riot, I think, is actually a good choice right now because of how everyone's going back into crypto. You could also probably do this with Coca-Cola. And the thing about this one, obviously you're not going to get a lot of premium off this, and you need around $6,000. You'll get like $8 per contract, but you have to be pretty close to the strike price. So maybe you want to go a little bit riskier with your $1,000 to get it to a little bit more money, but it's actually a good play. Coke, you could do it like this. And the reason why I would do it with something like Coke is that if you had the money, you could pretty much practice with stocks like this that move sideways. And that's always a good thing because you could actually see like the $2 go into your account. You're like, okay, it works. So let me try doing this with a little bit more of a riskier stock, or a riskier stock that you want in your portfolio. Let me be clear on that. But also, if you end up getting this stock, say, since the dividend is going to be in July, say you do this now and you just collect, say, $4 to $8 every week until the X dividend date, and then you'll get the dividend as well, and then you're double dipping, which is awesome. You got the dividend and you got the premiums, and then you can move on to the next stock after that because you got what you wanted. You got the premiums, you got your dividends, and you got probably your money back. Then you'll move on to doing other stocks with the wheel strategy. So guys, this was a really quick video that I just wanted to show you guys what I was doing for the week and one of the other stocks that could potentially do really well for you if you pay attention to it. So if you guys got any value to this video, if you want to see more videos like this, don't forget to like, comment, and subscribe. Check out the links down below if you love free money. Check out the links down below if you like free stocks and you want to help support the channel. And I will see you guys very soon. Peace.